Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark tells us the latest North American market correction came from China. Some shocking insights from Hilliard MacBeth, author of the book When the Bubble Bursts, Surviving the Canadian Real Estate Crash. We'll talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
And it's nice to be with you, Jim.
The market's a bit of a correction.
A bit of a correction started late in China with changes in the short sale positions that are going to be allowed there, and also some changes in terms of the margin requirements. So the Chinese market, which had done well during the day, up 2%, closed down, so that overall quite a reversal day. And in North America here, the ETFs, the A-shares ETF and the PEK down 5% on the day. But this all fits into, just in general what we've been seeing. A lot of speculation over there that became excessive, and if you look at the various oscillators, the relative strength, the stochastic or my exhaustion indexes, they're up to the point where you just need one negative piece of news and the markets tend to give up ground. And I talk a lot about bring up currencies a lot, just because I don't think most investors realize just how much it means to the bottom line for them. And with the action that we've had in currencies the last year in particular, for anyone who is dealing domestically with companies that are just dealing domestically, it really doesn't have too much of an effect. But when you've got either foreign investors looking into your country, or if you are an investor in stocks which have domestic costs and are able to sell and receive revenues from other countries, in particular examples like in Canada, if you've got fixed costs here, you're getting U.S. dollars. It's been a pretty good run from 2009 to the middle of last year, and it's just been an exceptional run from there until the end of January. My concern is that the companies, and I have a list of a couple of dozen that if people are interested, they can contact me, and I'll show them just exactly where sort of those moves have been and maybe what the vulnerability might be in the short term. Because I say vulnerability because the currencies, it's pretty much been a one-track pony here, where the number of speculative short positions in the currencies against the U.S. dollar is at sitting around all-time highs. The commercial positions on the other side are sitting near record highs in terms of long positions. And this is the type of thing we saw last summer when the crude oil market was up around 100 to 110 and the commercials were sitting there week after week with record shorts. You have to be cautious of these type of events. So what we've seen currency-wise is big moves that stabilized the end of January. They're starting to turn, and the Canadian dollar this week is a prime example. A rally from 79 cents to 82 3/4, all in a span of 1 week. Now, the catalyst was a good market in terms of crude oil to help it along, but the important thing here was looking at it was that the number of shorts, the positions that were there, all they needed was one trigger point to cause them to have to cover their positions. And when you see the turns in the currencies, it's going to have an effect on the equity markets. And we've looked and talked about, like the U.S. dollar, which is right now got support around the 96 1/4 level against the basket. If it breaks there, I think you're looking at maybe another 4 or 5 points on the downside, and that's going to have an effect on most equity markets.
An interesting stat came out. While the central banks want you to take out more money and stimulate the economy, the real banks are not doing that. Apparently, loan applications are down and rejections are up.
Right, and the charts, there's a couple of examples there from 5-6 years ago that are ones that make you want to be cautious when you see these kind of stats showing up right now.
Ross, thanks a lot for chatting with us.
And we'll be back with you next week, Jim.
If you have any questions for Ross, his email is ross.clark@cibc.ca. Ross is an investment advisor at CIBC Wood Gundy. Coming up after the break, Hilliard MacBeth on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is Hilliard MacBeth, investment advisor at Richardson GMP in Edmonton. Welcome to This Week in Money, Hilliard.
Well, it's great to be on your show.
He's the author of a new book, When the Bubble Bursts, Surviving the Canadian Real Estate Crash. Can you maybe tell us about that book and what kind of a message it has for Canadians?
Well, what happened, actually, I think is kind of interesting. I was actually writing a different book. I was writing a book that tentatively I was going to call The Buying Opportunity of the Century in the Canadian Stock Market and Why Everyone You Know is Going to Miss Out. And I was going through the reasons why people might miss out on that stock market opportunity. And when I got to real estate, I realized this is the big problem. The real estate obsession, really, that started maybe in 2001, had grown to be such a big thing that people would be caught in illiquid real estate investments, over-allocated to real estate, and they wouldn't have the opportunity or the means or the borrowing power to take advantage of the stock market. So the book came out March 21st. It's in all chapters in Indigo stores. It's available in ebook on both the Kobo and the Kindle version, and people shouldn't have any trouble finding it on Amazon, both Canada and the U.S. So it's and so I was just told by the publisher a couple of days ago that it's in reprinting status, which I'm not quite sure what that means exactly, but it sounds good anyway. So it's doing well.
That means people have bought so many copies they have to print more.
I'm hoping that's what it means. I don't know. I think what happens is they fill up the pipeline and then they have to print more. So, maybe they just underestimated the amount they needed initially, but I have gotten a lot of really good feedback from people that have read it and said that, it's easy to read it. You can read it all the way through. And, I tried to, because I've been, working with investors for, more than 36 years, I tried to write the book in such a way that I was just talking to a client or a potential investor and describing it to them. So I think that makes it understandable for people.
It's written in English, not technical gobbledygook.
Exactly. There are 13 graphs spread throughout the book, and there are a few statistics in there, but it's interwoven with lots of stories and my own personal experience and the experience of a number of my clients as well. So hopefully it's entertaining.
What are the real estate numbers you really pay attention to?
That's a great question because just yesterday the CREA number came out, which is the Canadian Real Estate Association, I believe. And there's also a REMAX index as well. But the problem with those numbers, those indexes, is that you're not necessarily comparing apples to apples. So as condos became more popular, what happens is the index gets skewed depending on the mix. So if you've got a lot of single-family homes, the price is going to be higher. If you've got a lot of condos, the price is going to be lower. And because of that, I prefer what's called the Terranet National Bank Index. It's been going for quite a while. It's a joint venture of an organization called Terranet and the National Bank of Canada. And they only track single-family homes, and they use actual sales data as recorded at the land titles office. So they would take a similar home and follow the progress of that home as it's transacted, maybe over a period of 20 years. And that index shows us for instance, in Edmonton, Calgary, Vancouver, the prices pretty much almost tripled since 1999, which is one of the things that convinced me that there's a bubble.
And I also saw a stat on the news the other day saying Canadian real estate had gone up 9.5% in the past year. But I don't think that takes into account what's happened in Alberta in the last 3 months.
Exactly. So, I mean, we could dig into this really deeply if you want, but there's a bunch of things. So, for instance, the way I describe it is, imagine you're looking at the stock market and you've got shares of Suncor or shares of IBM or Microsoft or BCE. There's millions of shares of all those companies trading every day. And so you own 1,000 shares of one of those companies and the price says $99 or $64. You can't really kid yourself that your 1,000 shares are worth, a huge amount different from what it's trading for on the stock market. However, in the real estate, it's not like that. There's only a small percentage of the homes that actually transact in any given year. It's a very small percentage. So you can, people, for instance, in Calgary, the numbers are showing that sales are way down, listings are way up, and prices have come down marginally. Maybe, I don't even know the exact number, but it's less than 10%. Well, that isn't actually accurate at all because we have no idea what the price would be if all the people that were trying to sell their homes actually priced their houses in such a way that they would sell in the next month or two. There's just no way to know. There might not be any price that would sell all those houses. If your listeners want to have some fun, go on realtor.ca and just put in whatever price you want. Just for fun, I put in 850,000 and higher in the Calgary area. There's over 1,000 listings. So how do you clear over 1,000 homes that are that expensive? I mean, the average income in Calgary is much higher than the average income in Vancouver, but it's still not that high. It's, the average household income in Calgary is probably about 100,000. So 850, that's 8.5 times household income. That's very difficult, even with the incredibly generous financing options that are available to Canadians. Extremely difficult for the average household to try and reach up to 850,000. So who's going to buy all those homes? It's very difficult. The first-time buyer not going to buy that expensive home. So that means it's somebody who's selling another home to buy that home. So now you've got to have two transactions. And there's very little in the way of activity going on right now. So what happens in a downturn like this, like we have in Alberta, is you get the sellers sort of stubborn and stuck at their, what I call the anchor price. And you got the buyers who either are scared and don't want to buy at all, or maybe there's opportunistic buyers out there, but they're being very aggressive. They want to pay a really low price because they know the situation and they feel that they deserve to get a bargain at this point in the cycle.
Is that something that really skews the prices when they say, oh, the average price it's selling still is $850,000 in Calgary, but nobody's buying, so how can you say that's the average price? That's exactly what you're saying, right?
And exactly. And what happens is, and that people don't realize this, I didn't, until I did the research, I didn't really fully understand it myself. And it was a few transactions, especially at the higher end, can skew the numbers quite dramatically. So, the averages, especially in real estate, don't mean anything. The average price of a bunch of shares of Microsoft or IBM or any stock like that you want to mention is a very clear, precise indicator of what you could get for your shares in that company. But in real estate, it all depends on if you're on a particular street in a particular house, it might sell right away at the price you're asking for, or it might not sell at all. And it could take a year, it could take 2 years to sell, depending on how stubborn you are on the price.
And as you said, higher end real estate, that's bought by people who are multimillionaires. For them, upturns or downturns in the economy really don't affect them. They have a lot of money to spend anyway.
That's right. And so what you might be getting, and I noticed, and you noticed it obviously too, lately in the last few days, we've had a couple of reports that sales prices in Toronto and Vancouver are rising by 5 to 10% year over year. And those are pretty phenomenal numbers, but what might be happening and I don't know this. We'll find out fairly soon, I suspect. But at the moment, I don't know what's happening. But possibly what might be happening is that the lower end buyers are running into trouble with financing, running into trouble with their jobs, running into trouble with down payments. So the number of lower end homes that has been bought and sold is shrinking, but the higher end buyers that you mentioned that have cash, wherever they have their cash from, they're continuing to buy. So the index would get skewed by the average. That's why I don't really like averages at all. What you want to do is find an index like the one I mentioned earlier that tracks a similar home over a longer period of time. And it's a very difficult thing. And the other thing that leads to this differential between the lower end and the higher end and different markets and stuff is people can stay they can pretend that their house is worth a lot more than it really is, because they don't necessarily have to put it up for sale, and they can say, well, that house that sold at that ridiculously low price, that was a special case, because the owner of that house I know had lost his job and he was desperate to sell, so he took a much lower price than the market price. Or maybe the bank foreclosed on that home, so it got dumped for a really low price. So he can still believe that his house is worth $1 million, even when similar houses on the same street are selling for $600,000. So it's a very odd situation with indexes, and we saw the same thing in the United States during their correction. There was all kinds of different things, and of course that was very skewed by things like foreclosures and short sales and the banks getting involved and all that kind of stuff.
We'll have more with Hilliard MacBeth next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking to Hilliard MacBeth, investment advisor at Richardson GMP in Edmonton. He's just put out a new book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. Hilliard, in Vancouver, I think one of the things, too, that might be driving up the average prices is they are buying up entire blocks of houses along the Canada Line SkyTrain line in Vancouver so that they can put up high-rise condos. And people are being offered up to 3 times the assessed value of their single-family home for this. So if you take into account those sales, what is that doing to the average price that the Real Estate Association will tell you about?
Yeah, I mean, there's all kinds of things happening. I was talking to, as a result of bringing this book out, I've actually met a number of interesting people that are in the real estate business who have contacted me and who I never would have met otherwise. And I've learned quite a bit from them. And one of the things I learned was that, you know how we talk about the generous financing under CMHC and how people can buy homes because interest rates are so low. Well, the other thing that doesn't get talked about much at all is the fact that developers really only have one factor that they consider when they're deciding to do a development, and that is the availability of financing and the cost of financing. So I guess 2 things, but it's all to do with the financing. So the extremely low interest rates that we've got right now are encouraging builders to develop a very, very large amount of new supply coming onto the market, whether it's Vancouver, Toronto, Edmonton, Calgary, Regina even, or Saskatoon. All of these places have developers, and developers are not really that sensitive to what the demand is going to be 2 or 3 years down the road. If they can get financing, they will go ahead. And if they can make the deal work, they'll go ahead and sign up for the deal. So so that's eventually what causes the bubble to burst, because you get an increase in supply along with at the same time as the demand, and eventually the developers will overdo it. And perhaps in Alberta they already have, but perhaps in Vancouver, as you point out, they haven't yet quite reached that point.
Well, Ozzie Jurock, one of the big local condo developers here, I know a couple of years ago he was saying, oh my God, prices are going to plunge because there are 7,000 new condos on the market in Vancouver. Well, the prices didn't come down. The demand was there. And I think it's simply because people can't afford to have a single family home anymore within a decent distance of the city.
Yeah, Vancouver's a real special case because there's all kinds of restrictions, and I don't want to suggest that I really know very much about it. I'm sure your listeners and you probably know more than I do, but I understand that there's very restricted rules on what land can be available for development and that sort of thing. We don't have that in Calgary and Edmonton, and really not in Toronto either. In terms of there's lots of land available. In fact, one of the myths that I discovered in my research was that there's this whole idea they're not making land anymore and there's a shortage of land. In the United States, in the 2000 census, the census established that less than 3% of all the land mass in the United States is classified as urban land. And in Canada, of course, it would be much less than that. So, and even within a densely populated area of urban land, if you really look closely, you can see lots of parking lots and lots of areas that haven't been developed yet. So there's lots of room. But of course, single-family homes are difficult to find the space for. We have a lot of infill housing that's going in Edmonton and Calgary, and that's actually one of the things that's actually caused the excess supply, especially in Calgary, is a whole bunch of infill houses that were built in the high-end neighborhoods in Calgary on spec. And now the builder is trying to sell them, and I'm sure that'll be a source of desperation fairly soon.
When you're judging Canadian real estate, do you have to look at individual markets to really get a good, accurate picture, and not just the national picture?
I don't so much, and the reason I have clients all across Canada in my investment practice, and I was getting the same message from everybody. It was interesting, actually. There were always different reasons. Vancouver, well, you would know the reasons. Edmonton was the oil sands. Calgary was, Calgary. Regina and Saskatoon had different explanations why their housing was doubling and tripling in the last 15 years. Toronto was immigration. Montreal, it doesn't matter where you go. Everybody's got a reason, and that's one of the symptoms of a bubble, according to Robert Shiller, who's the Nobel Prize economics professor from Yale, who also developed the Case-Shiller Home Price Index in the U.S. And has written several books on exactly this topic. And people tell each other stories why these elevated prices make sense, and that is one of the main symptoms of a bubble. So I even got to the point where I was making a joke about it. So I'd say, well, I'm thinking that real estate's going to be a bad investment because prices have gone up too fast, and it's a bubble, and all bubbles eventually burst. And but then I say, but Vancouver's a special case, so you'll be okay. And then I laugh because it's just phenomenal. I can't tell you how many times I've had conversations where people say exactly that. Say, well, I agree with you, Hilliard. Toronto that's obviously a bubble. It's going to burst. And Edmonton and Calgary, well, obviously, that's a boom-bust province. But Vancouver, with all that foreign money coming into Vancouver, the bubble there will never burst. And then just change the story and change the location, and you got exactly the same conversation. So, no, I don't really think I've heard that argument many times that there's individual markets and but the reality is that in my research I found that the bubble is so massive this time that it'll be a nationwide thing for sure. The other way I know that is because when you look at the United States, our house prices are significantly higher than the prices in the United States. They're even higher than the prices in the United States were before they had their massive price correction. It's really impossible, unless we have maybe within Canada, maybe a market like San Francisco or Manhattan, where you might find it doesn't drop quite as much. But if there is one in Canada, that's probably Vancouver. And, Vancouver prices are the most outrageous of any market, not just in Canada, but in North America, perhaps in the world even. So they've got a lot further to fall. So, I no matter how you cut it, it looks like we're in a bubble, and a bubble that is going to burst, and it's going to hurt a lot of people, and that's what pushed me to dig into this topic, and then eventually turned into a book.
Would you say that the Canadian real estate market now is risk on or risk off?
Well, I think people are generally basically in a position now where they've completely lost their fear of debt and lost their fear of the possibility that home prices could decline. So that is a sign of a very large appetite to take risk. But because people don't see it as risk, the real estate market is unusual in that respect. I've been in the stock market myself for 40 years now, and I know that individual people in Canada are always thinking about risk when they get involved in the stock market, with the possible exception of a few months in the dot-com bubble in 2000. But generally people, when they go and think about going to the stock market, their first question is, well, how risky is it? How much risk? But when you talk to them about housing and maybe helping their offspring, their millennial offspring, get into housing, their attitude is basically, house prices can only go up, they can't go down. So if you don't get in now, you'll never be able to get in. And so that's a sign that there's no sense at all of it being a risky idea. And then layering on top of that, the idea of borrowing such a large amount of money, nobody would ever borrow that large amount of money to buy into the stock market. They would instinctively know that was a risky thing. But somehow with housing, that attitude isn't there. So it's kind of like a permanent idea that there's no risk in the housing market, which is, of course, when the bubble bursts, will be replaced by something else. But for now, that's where we're at. And I don't know how we got into this situation. One of the most shocking things to me was how Canadians lost their fear of debt. The debt bubble, we could almost talk about that even more than the housing bubble, because really without the debt bubble, you couldn't have the housing bubble. There's no way. I know there are some people in Toronto and Vancouver and even in Edmonton probably who show up with cash to buy houses, but it's very rare. Most people, there's all kinds of stories in Edmonton of young couples being offered $1 million worth of mortgage, and I'm sure in Vancouver too. And that is a very recent phenomenon. I can tell you without any hesitation, without any doubt in my mind, that this is a brand new thing that people would even remotely consider taking on that amount of debt. And you could say, well, it's because of the low interest rates, but there must be more to it than that. It's a big thing. And then when we saw, I'm sure you remember, just 7 or 8 years ago, people talking about in the United States where they were using their house as an automated teller machine, drawing cash out of their house equity and stuff. And we talked about subprime mortgages in the U.S. and we all looked at them and said, oh, those people are so crazy, they're so stupid. Us Canadians, we're so prudent and we're so careful, we would never get into something like that. Well, here we are, 30-year-old couples, just starting out in life with their first, good job, with a total income of $250,000, routinely being offered $1 million worth of mortgage financing to buy their first house. That never happened before. This is brand new.
What about the parents helping out people? In Vancouver, almost half of real estate sales are because of that.
Yeah, well, in the terminology, I've discovered this phrase, the bank of mom and dad, and I've seen those numbers. It's not my phrase. I borrowed it from somebody. I don't know what the origin of it, but it certainly describes it. I've seen those numbers, a quarter to half. I think in reality it's actually higher than that, because I don't see any sign at all of people in their late 20s, early 30s being able to save up enough down payment to buy anything in Vancouver. Even the most modest home in Vancouver, a 20% down payment would be a couple of $100,000, and nobody that young could possibly save a couple $100,000. You could say, well, if they were a doctor or something, they maybe have the income potential to get into a house like that. But to become a doctor, you have to go to school until you're almost 30 years old. So they haven't been working long enough to be able to save up a down payment that large. So there's definitely a very large component of either borrowing the down payment, which technically on CMHC insurance you're not supposed to do, or getting the money gifted from the bank of mom and dad. I'm sure it's probably higher than 50%, and then that goes back to the baby boomer phenomenon, which is baby boomers have done very well in real estate, and I think what's happened is they've decided that they want to pass that legacy on to their kids. And so they're willing to help out with large down payments. I've had this conversation with a number of clients where they'll come in and actually they say the first part of the meeting is, well, do we have enough for retirement? Are we gonna be okay? And then maybe they're only 5 years away from retirement. And it's a challenge these days to save up enough for retirement. Even on a $2 million investment portfolio, which is pretty rare, if you use the 44% rule, that's only $80,000 a year in income, and these people are used to incomes much higher than that. So you go through that with them, and then the next thing they say is, "Oh, by the way, we need $100,000 because we're going to help our 30-year-old who just got married with a down payment for a house." And so you want to back up and say, "Well, wait a minute now. 1 minute ago you were worried about having enough for retirement, and we kind of went through that, and now we're withdrawing $100,000 to help young people get into an extremely overpriced housing market and encouraging them to take on a bunch of debt." It just doesn't hold together. So when I probed further into that, it turns out that the universal belief is pretty much universal anyway, that there's no risk because house prices always go up. And that also means if house prices go up, then logically, the earlier they get in, the better for them, right? So we're willing to help out our 30-year-olds get in early, probably much before they need to actually buy a house, because it'll only be more expensive later on. So there's a bunch of flaws in the logic of all that, but that's become the standard in Canada.
Looking historically and mathematically, how far is the Canadian real estate market likely to drop?
Well, there's three ways to look at it. So the first way, which gets a fair amount of play in the media, is the house price to income. So leaving aside the people that come from foreign countries with cash to buy houses, basically the housing market is totally dependent on people earning their wages and their salaries, and every 2 weeks or every month paying the mortgage payment until eventually they pay the mortgage off. So it's really important that house prices don't get too far ahead of wages and salaries so that people can afford. And the affordability measures are completely out of whack, off the charts in Canada. So for decades, the affordability measure showed it. The house price couldn't get much above 3 times. It fluctuated between 2 and 3 times household income. So again, we don't want to use Vancouver numbers because household incomes, turns out, are actually quite low in Vancouver. But I'll just, it's $65,000. So if with that 3 times multiple, say 70,000, just to make the math easy, the maximum affordable house would be $210,000. So that's almost a joke in Vancouver, I know. In Edmonton and Calgary, it's a little easier because incomes are much higher, or at least they were much higher until recently. So household incomes in Edmonton and Calgary are roughly $100,000. So on that basis, people should be paying about $300,000 maximum for a house. Now, the multiples in Canada overall are up above 5 now. In Toronto, they're at 6 or higher, and in Vancouver, they're over 11 times. So, and that was before these latest numbers. So that would imply, if we take the national average of over 5, and let's assume we have to get back to 3 as the high end, although these things generally, when the bubbles burst, they don't stop until they go below the average for a while. But if we just take the higher number, the 3, and go from 5 down to 3, that's a 40% correction, which is pretty serious correction. It's as bad as what they did in the U.S. A few years ago. The second way to look at it is, it's true over the centuries and over the decades that house prices have increased at the rate of inflation. The only time that that's really been different is this recent bubble where they've increased much faster than the rate of inflation. And for a short time after the Second World War, when a lot of the servicemen came back from over the war service, and they wanted to get married right away and start a family right away, and there was a severe shortage of housing. So there was quite a jump in house prices and apartment prices right after the Second World War. But other than those 2 times, there really hasn't been any long-term time when house prices went up faster than the rate of inflation. And that's because wages and salaries also go up at the rate of inflation. And in fact, the last few years, the wages and salaries have lagged behind the rate of inflation, except in North Dakota and Alberta. So if you take that, if you go back to 1975, as I did, and you figure out what the house price should have done, it should have gone up 4-fold on average in Canada. And what it did, it went up 9-fold on average. So based on that measure, house prices have to correct more than 50% to get back to the trend line, which would be rising at the rate of inflation. The gap, by the way, between the cost of a house based on inflation and the bubble cost of a house has been entirely financed by debt. So the only way that you can't go to your boss and say, "Hey, I need a 50% increase because house prices in Vancouver are so high." So you're not going to get that. If you go to your boss, he's not going to go for that. So the only other way to do is go to the banker and say, I need to borrow way more money than you've ever, usually consider lending to somebody like me in order to buy a house. And of course, the banks have come, with the help of the CMHC and the Government of Canada, to a point where they are willing to accommodate that. So that's the second thing, and that tells us that we need a more than 50% correction in house prices. And then the third one, all three of these are very valid, I think, is to look at the U.S. So Canada is a trading nation. Canada is 30 to 40% dependent on exports and imports for our economy. Our biggest trading partner by far is the United States, and we have to be competitive with the products we sell to the United States, whether it be auto parts, cars, or oil and gas, or lumber, because they have options. They can buy a lot of that stuff from Mexico. They can buy some of it from other places. There really isn't any product that Canada sells to the United States that they couldn't find someplace else. But we're closer, and we've got long trading ties with them, so we're kind of in the best spot. But it's very dangerous for Canada to allow our expenses to get much, much higher than what the expenses are in the United States, whether it be wages and salaries or housing costs or whatever. But the reason housing costs are extremely important is that that's the number one determination of what that first-time buyer, that new employee needs to make at their job in order to buy a house or to buy a condo and get married and start a family. And right now in Texas, house prices for that first-time buyer, that young person, young married couple, are less than half of what they are in Edmonton and Calgary. So we got the same product, oil, natural gas, similar situations in a lot of ways, and it's much, much, much cheaper in Texas. And then don't even talk about Mexico. That's another story. But Mexico also has oil and gas, and it also has auto parts, and it also has car manufacturing plants. For instance, in Ontario, there hasn't been a single new automobile manufacturing plant built for I don't know how long. It's at least 10 years. And in Mexico, I think in that same period of time, there's been 5 to 10 new ones built, and there's more planned.
And they just announced that a major plant in Ontario is closing and moving to Mexico. So that trend continues.
Exactly. And the reason is our costs are too high. And the number one cost so when we, I described this in the book, my wife and I did a renovation, and we did it in Edmonton, and we did it at exactly the wrong time, 2007, just when the oil sands construction boom was at its peak. And I kept asking the contractor as time went by. Actually, we got into 08 and 09, and I said, $50 an hour for somebody just to pound nails into a board? This doesn't make sense. There's a global recession on. There's a financial crisis and all that. And the answer came back, well, if I ask them to lower their prices, they'll just go and work in Fort McMurray. That's what they. And the other answer they gave me, which was equally interesting, was they said that's what it takes to live, to survive in the Edmonton economy. They need that amount of money. That's the minimum they're willing to work for. Well, if we've priced ourselves in Canada that high, but we have to sell all our products to the United States, something's got to give here, and it's a very dangerous thing for a country. And Canada's been very fortunate with all the commodities that we have and all the natural resources we have, and education, everything. We've got a lot of things going for us, but we could screw it up if we let our costs rise to the point where we're no longer competitive. And now we are lucky in the sense that we've got our independent dollar, and the dollar can drop as it has about 20% in order to try and alleviate some of the differences. But the differences are more like 50%, not 20%. So we need further competitiveness improvement to maintain our status as a major trading nation.
If the Canadian real estate market collapses, what's that going to do to the overall economy?
Well, it's quite serious. A friend of mine warned me about this. He said, Hilliard, you're bringing out this message, and it's very timely, and it's important and all that, but you're not telling people what they want to hear. But it is important to understand. So as it turns out, real estate and all related activities to real estate, and there's a bunch like advertising, commission sales, and realtors and lawyers and all that kind of stuff, is a very significant part of our economy. Just the construction, new construction and renovation is 7% of the economy. And if you add up everything, including financing and everything, you get up into the 25-30% range. Much, much higher than the oil sands, or even all of the oil activity and all of the mining activity put together. So real estate is extremely important. And by the way, 7% of the GDP of Canada for construction of new homes and renovation of existing homes is higher than it's ever been. And the thing that's worrisome about that is it's been at this level for several years now. Now in the U.S., we've got a direct comparable in the U.S. They hit 6% for 1 year, just 1 year, just before the meltdown in their real estate market and the global financial crisis. And then it dropped to 2% of GDP, and now it's bounced back to 3% of GDP. So we are investing slightly higher than the U.S. was at their peak, and at more than double the rate that the U.S. is now into new home construction and renovation of existing homes. And it's really too big. It's become too big a percentage of the Canadian economy. Just think if we'd been investing that money in something more useful, which would be, automobile plants to use that thing, or even technological advances in BlackBerries or something like that. I mean, there's any number of things we could have been investing that money into, but unfortunately, we've chosen to put it all into to real estate, and that's going to be a legacy. It'll have to be worked off. I mean, in the long run, it'll work out, but in the short run, the adjustment's going to be quite painful. The other country in the world, by the way, we're not alone in this. Australia is very much wrapped up in the same thing as well. And China, the numbers for China, I wasn't totally surprised, but it is a little shocking when you look at the dependence of the Chinese economy on construction and residential real estate, and all. Of course, in China they do lots of infrastructure construction. If we had shifted some of the investment that we did for residential real estate into more infrastructure construction, I think that would have been better, and I'm pretty sure that's what's going to happen when the real estate market slows down, is some of that investment is going to move into more productive types of investments like infrastructure.
Hilliard, after this supposed crash, what kind of a recovery can we see, and should people maybe wait if they want to buy a new property and wait until this happens?
Well, for sure they should wait. In my opinion, it's pretty clear cut. I mean, there are people, and I would put myself in this category, that have we're lucky to have a very nice home, and it costs way too much money. And I describe the process in the book. If anybody's interested, they can read about it. But we do have other investments. We've got savings and RSPs and investments in the stock market, and I've been doing this for 40 years. So, but if somebody's starting out in life and haven't been able to save up any money yet, and are looking at things like RSPs and TFSAs and mutual funds and all that stuff, I would encourage them to rent and to start building up some savings first before they buy, because I think they're going to get a much better buying opportunity in a year or two. And for older people like myself, the baby boomers, if you've got too much house and I had an interesting experience. We had to get a home equity line of credit because that renovation I mentioned a minute ago ran way over budget. As I guess that's standard, though, isn't it? And the banker that came and talked to us about that home equity line of credit, he said, well, you've got this big house, you've got 4 bedrooms, there's only the 2 of you left, though the kids are all gone and moved out. What you do is you take that portion of the house you're not using and you lever it up by borrowing against it to do other things, to invest money or to buy a second property or to take holidays and that sort of thing. But the other possibility, which is equally valid, or I would say more valid, would be to say, you know what, we've got too much house. Let's sell this house and downsize to a smaller place. And if somebody was thinking that way, I would encourage them to rent for a while rather than... I've had so many clients over the last 20, 30 years who are a little bit older than me and have gone through these various phases ahead of me. And nobody seems to take money out of the housing market when they get to that stage where they got the big house and they want to move to a smaller place. They end up buying something that's not as big as what they had, not as nice as what they had, but just as expensive as what they had. So the other option would be to rent. And whenever I mention this, people aren't really very receptive to it. But think about it. You're going into retirement. You've got some money saved up. You have a nice house. It's worth $1 million, $1.5 million, maybe even $2 million in Vancouver. Think of what that would do for your retirement. And this whole idea that renting is more expensive than owning is just completely bogus. When you run through the numbers, especially with house prices as high as they are now, it's much, much cheaper to rent. And there's lots and lots of condos that are sitting empty in every Canadian city that I'm sure people can find to rent if they put a little effort into it.
When real estate markets collapse, what do foreign investors do?
They run. So this is another thing, and this is interesting because I mentioned the thing about different cities, and everybody has a different reason why their housing market will be exempt from the looming crisis in real estate. But it's also true for foreign investors. Foreign investors, we think that Canada is the only option for those foreign investors to invest their money. But if the housing prices start to turn down in Canada and Australia, let's say, just to say that those two maybe being the most outrageous bubbles in the world, start collapsing at the same time, those foreign investors, to the extent that they're as big a factor as allegedly they are, they can move to other. I mean, they're not going to buy into a real estate market that's falling in price. They're going to want to buy into a real estate market that's rising in price. So when they start pulling their money out, or just not putting new money in, that'll exacerbate the bursting of the bubble, and I'm sure that'll happen. It's probably not as big a factor as people think it is, except maybe in Vancouver and maybe in Toronto. But even there, it really comes down to the local buyer, and really it actually comes down to the first-time buyer. This is a concept that nobody ever talks about, and that is really the only new money that goes into the housing market, other than the foreign buyer, is that first-time buyer. For the people that already live, that have homes, they sell and they buy, but there's not a lot of new money going in or coming out. They're just trading from one position to the other position. So that new couple that comes in, maybe 28, 29, 30, 31 years old, goes into that bank office, signs that document for $300, $400, $500, $600, or even $1 million on that mortgage paper. That's brand new money that's going into the market. And that's really the only brand new money that goes into the market. So if prices get so high that first-time buyer just can't do it anymore, that's where the house of cards starts to come down.
How big a role does China's economy and real estate market play in Canada?
So I went to a conference in New York, and I think it was 2010, and I was listening to a strategist from a Swiss-based global banking firm, and his job was to follow the equity markets around the world, and he was talking about the different markets in his presentation, and he didn't mention Canada. And so at the end of the presentation, I went up to him and I said, "What about Canada? What's your read on Canada?" And he says, "Canada's just a play on China." And he was talking about the stock market, of course. And I was kind of shocked because I'd never heard that before. So I pushed him, and you know what? He convinced me Canada is a play on China. Now that's it. It takes a couple of steps to work through this, so bear with me. Canada's income and Canada's fortunate place in the world is very dependent on commodities and resources, natural resources. We don't really sell much of our commodities and natural resources to China. We'd like to be able to do that, but that requires pipelines to the West Coast and all that. We don't have that yet. So at the moment, we sell most of our commodities and our natural resources to the United States, and that's where it goes because of proximity. But his argument was that China is the one place that pushes commodity prices up and down in the world. So, for example, China buys 60% of the world's iron ore, 40% of the world's copper, 40% of the world's nickel. It's what you would call the buyer of last resort for all of these commodities. Even crude oil. There's some story that the collapse in the crude oil that's happened in the last 6 months is due to the shrinking demand in China. So even though we don't sell directly to them, our good fortune or our lack of good fortune is determined by China. So what are the principal factors in China that are causing China's economy to do well or to slow down as it is now? Well, it turns out that China is very dependent on construction activity. So copper is used in housing and building buildings. Nickel is used in stainless steel, goes into appliances. Iron ore is used to go to steel, which is used to build buildings. So so we are levered as a country onto our own residential investment and our own construction investment. And then on top of that, our commodities prices are connected to what happens in China. So the slowdown in China could affect us pretty directly. It'll be, if it continues, the slowdown that we're currently seeing, it'll be even more devastating. It'll be hard on us, but it'll be even more devastating on Australia because Australia's percentage of the commodities that they sell much more directly linked to China's economy. And the other country in the world is Brazil. So the three, Canada, Australia, and Brazil, with Australia probably the hardest hit, would suffer from China's slowdown. And we don't know, as I'm sure you've talked to other people on your show, the numbers out of China are very suspect in terms of the growth of the economy. They always hit their forecast GDP number, for example. It's never off even by a couple of percent, so it's kind of suspicious. But even assuming that the officials in China sort of manage the numbers and manipulate the numbers, they've been lowering the expectations, quarter after quarter, and now we're down even below 7%. And not that long ago, they were above 10%. But a lot of that is a slowdown in construction, which is commodities.
The federal election is scheduled for October in Canada. Does the government have any way to manipulate real estate to make it look positive for them, at least until the election happens?
Well, the government certainly has been involved in creating the housing bubble in Canada, and the CMHC financing is a very significant portion of the Canadian mortgage market. CMHC plus there's one other private insurer. I was shocked to discover that the government of Canada guarantees 90% of the liabilities of the private sector insurer as well, and 100%, of course, of the CMHC insurance. So that's been a mechanism that they've used to promote the housing market as an engine of the growth of the Canadian economy, really, since before the global financial crisis and especially after the financial crisis. There isn't a whole lot more they can do at this point. They've talked about reining in CMHC, the subsidy that goes from CMHC to the Canadian banks and to the housing market. But there isn't really much they can do. They've also talked about privatizing CMHC, which is really ridiculous. The idea that there's an entity in the private sector that could handle that much liability is just really laughable. But they've made these noises, but they haven't done anything, and they won't do anything before October. It's a very, very heavily levered machine working from the housing market through the Canadian banks, through CMHC to the federal government. The liabilities are well in excess of $600 billion in total, and the total government debt in the federal government in Canada is $600 billion. So off balance sheet, they've got really more exposure than they do on balance sheet. But it's worked very well for them because they still have a AAA credit rating, because the credit rating agencies don't really see CMHC liabilities as being a problem for the Canadian government. But in a housing downturn of the kind that the U.S. suffered, or as Ireland did, or Spain, or Japan, or any of these countries, that would become a factor in the AAA credit rating. And it's interesting because that affects the banking system, because right now, because CMHC insured paper is considered equivalent to AAA rated paper because of the government Canada guarantee, the banks don't have to keep any capital. It's zero risk weight in their calculation of their capital for the regulatory authorities. So that's why they've drifted into this very high percentage of their activity being related to lending to households in Canada and residential real estate, because it's got this wonderful opportunity that their return on equity goes through the roof. One of the large Canadian banks that I described has a 37% return on equity in their Canadian lending division. By comparison, Wells Fargo, which is arguably the best managed bank in the United States, and it's also very heavily involved in lending to the residential housing and mortgage markets, has a 13% return on equity. So the large Canadian banks, almost 3 times the return on equity, and it's all because there's no comparable situation in the United States as there is in Canada related to the CMHC financing. It's a wonderful, wonderful thing for the banks that they have this availability of the CMHC. But it's not going to be very wonderful. It's going to be quite ugly for the Canadian taxpayer when the bill comes due. So none of that's going to happen, to get back to your question, before the election, which is likely to happen in October. But I would be, when there is a housing correction, I would think that whatever government is, and obviously the government will probably change if the housing bubble bursts. The first thing voters will probably do is throw out the current government. There will be a tightening up of that relationship, and that's a good thing. But in the short run, of course, it'll be painful, because that'll mean the financing will be less available, because right now the banks can put out as much financing as they want because they know that they don't have to worry about the payback because of the insurance that is sold at a very modest price. But if they have to worry about it, then they'll be much more stingy with their lending. There won't be any $1 million mortgage loans offered to 30-year-old couples that have only been working for 1 year after that change.
Hilliard, could you maybe again remind people about your book and your website?
So the book is called When the Bubble Bursts, Surviving the Canadian Real Estate Crash. It's available now in all the bookstores and online, and the website is called themacbethgroup.com. And I also have a weekly note that I do called Hilliard's Weekend Note on a blog, and it's about any topic that I decide to write on that week. It isn't always about real estate. It's, of course, we have a very large and successful portfolio management business that we run as well. And so I talk about the stock market. And last week I talked about Greece and the possibility of Greece having to exit the European Union, that sort of thing. My
guest has been Hilliard MacBeth, investment advisor at Richardson GMP in Edmonton. His book, When the Bubble Bursts, Surviving the Canadian Real Estate Crash. His website, themacbethgroup.com. And that wraps up our show for this week. Thanks to our guests, Ross Clark and Hilliard MacBeth, and thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.